All right, so far we talked about the components of cost that go into a long-term asset. We talked about different depreciation methods. We talked about partial year and change in estimate of useful life. Now we're going to talk about when you get rid of a property, plant, and equipment. And it's sometimes referred to as disposal, a sale. If you sell long-term assets, that's a specific type of disposal. So you can dispose of something by selling it. So you have a buyer, you can have a scrapper who uh, buys it to recycle the steel or what other components may be recyclable, or a waste handler. You just may throw it away. What is this thing right here? Okay. So how are we going to account for the sale? You're going to remove the asset, which would mean crediting the asset account. Its associated accumulated depreciation, which would mean debiting accumulated depreciation account. Debit cash, if you're selling it, you receive cash. And credit gain, if you have one, or loss on disposal, if you have a loss. We don't call this sales revenue because you're not in the business of selling your long-term assets. If it were an item you're selling out of inventory, then it would be sales revenue. So one company sells a truck. If it's a delivery company, to them it's a long-term asset. If an auto dealer sells a truck, or a truck dealer sells a truck, they're in the business of selling trucks. It's inventory. So that's how we classify the difference between gain and revenue. They're both part of operations. They both increase retained earnings. They both increase net income. But revenue is a part of core operations. Gains are non-core activities. Okay. And here's the two template journal entries. The only difference between the two is a gain versus loss on disposal. Here we're eliminating accumulated depreciation, eliminating the plant asset, eliminating accumulated depreciation, eliminating the plant asset. So we're going to use the same truck from the prior videos, and we're going to use straight line. 80,000 cost, 10,000 residual value, 5-year useful life. So one of the key principles that GAAP has for you when you do this type of problem is you must depreciate it up to the date of sale. So they're going to sell this truck on July 1 of 25, and they bought it on January of 2000 X1, 20X1. So that's year 1, year 2, year 3, year 4. That's 4 years of depreciation, and then half a year in the last year of its useful life. And they're going to sell the item for $22,000. Record the sale. First of all, how much did they depreciate up to the date of sale? There's 60 months in 5 years, so this is 60 months. Here's the depreciable cost. This is, in parentheses, is depreciation per month. And how many months? 4 times 12 equals 48. And then last year, they had 6 months. 48 plus 6 is 54. Put this all together, 63,000 of accumulated depreciation. So you have the cost of the truck was 80,000. Accumulated depreciation was 63,000. So the book value on the sale date was 17,000. And actually this line shouldn't be here. The sale price was 22. The difference is 5,000. So they bought something that on your book said it was worth 17,000, and you sold it for 22, 5,000 above that. So that would be a gain, which would be recorded on the income statement. It might go through an account like other revenue or something, but it will increase net income. So this is just repeated from before, and this gain goes right here. You received cash of 22, accumulated depreciation of 63, $80,000 cost of the plant asset you write off, So just to check, debits equal credits, and look at that. 85,000 equals 85,000. And that's your gain or loss. All right, now you might see a problem where in exchange they dispose of it, but in exchange they get a truck. So if you get another item, it's not cash, you could put truck here or equipment or whatever. Okay, but these are sales. So this is how you would do a sale for cash.